Welcome to RenMac Off Script. We openly discuss markets, economics, policy, history, and life. It's the 17th of November, 2023. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account at RenMac LLC and the RenMac LinkedIn page. And if you're listening, but you're not an institutional client and keeping up with the markets is important to you, then visit RenMac Access. It's renmacaccess.com. It's a site that we've designed to give RIAs and intelligent investors the insight to some of the ideas and the topics that we're discussing here. Again, that's renmacaccess.com. We've got meeting between Biden and Xi. We avoided a shutdown, but with that, Steve, I'm going to put that on the back burner for now. I think the big news of the week was the inflation data, Neil, that seemed to give the Fed a path to sitting on their hands. What did you see out of the inflation data, and maybe, as importantly, some of the other data that we've seen this week? Any thoughts on what that's going to do to the Fed, and does that prolong or extend what you think is a pause here?
Well, I think it reinforces a pause. We haven't thought that the Fed would be going in December for a long time now, but I think what's changed for us isn't so much the, probabilities around December. It's really about what the probabilities will be for early next year. And I think it not only puts them on a path to an extended pause. I mean, remember, the Fed hasn't done anything since the summer. So what's more likely at this point is that you're opening up the door to cuts sooner than many have thought previously. And, I think you can't rule out a March rate cut. And frankly, we see a donut on the headline inflation number, but there's a lot of disinflation in the pipeline. I mean, used car prices are still deflating. If you look at supply chain pressures, they continue to ease, which should suggest that prices for things outside of cars will keep coming down. There's still disinflation in the pipeline for rents. I mean, market-based rents remain, they continue to contract, and that should lead the CPI measure for housing rental inflation. And just look at the Fed's own forecasts. I mean, based on our work, if you take the inputs of the consumer price index and the producer price index, and you use that to make an estimation around the October PCE data, which is the Fed's preferred measure, core PCE will rise 0.17% month over month. Therefore, in order for the Fed's forecast for the fourth quarter to be met, you need to see core inflation rise 0.5% in each of the next 2 months after that, in November and December. That is a very tall order. So you're going to see the inflation estimates for the Fed come down. And if that's what's going on, then it means that there's an opportunity there for them to cut. I mean, if you think about a standard Taylor rule type of model, they're basically right there. When you relate changes in unemployment and inflation to a Fed funds rate target, they're basically where they need to be. And if inflation continues to cool, we may well be under 3% year-over-year inflation by March. If that happens, they should be cutting. Not a lot. I mean, I think it's basically a recalibration of policy. But if you think about the 94-95 experience, the Fed hiked very rapidly in 1994, and they walked a few of those hikes back, and they sort of stood back and saw how the economy behaved. And that's really all we should expect right now. I don't think we should expect a very deep cutting cycle, and that's because the economy is still fine. I mean, we had retail sales this week. Core retail sales were fine. We had October building permits, single-family permits continue to climb, housing starts continue to climb. Obviously, the drop in mortgage rates will probably provide further momentum behind the housing market. We're seeing that in things like, what's going on with home building stocks. Manufacturing was obviously quite weak in October because of the strike. But now that that's over with, you should expect to see some rebound in production as well. So I think it's sort of the best of both worlds right now for the economy. I think you have, real growth is holding up, certainly not as strong as it was in the third quarter. But the bigger point is that inflation is slowing, and that's important. So it's, the economy's got a little bit of a kick here, and I think that's being reflected in the markets.
I mean, two things on that. One is some of the doomsdayers will look at that and say, the Fed's overdone it, and we're just starting that deflationary spiral, right? But Your point is well taken, particularly as you look at it from the market's perspective, right? Discretionary stocks moving, restaurant stocks made a new relative strength high, home builders made a new relative strength high. I mean, these are not things that happen as you're about to spiral into the
Well, of course not.
graveyard.
But also, as you know, Jeff, these folks, these doomsdayers, you know, doom and gloom newsletter writers. Remember, they start with the conclusion first.
Yes, definitely, for sure. Yeah. Well, you know, the thing that's most interesting, and we've been saying this, it's been a long time. I mean, it's looked this way for at least 6 months. I think it's longer than that. These real yields, right? When you start looking at real yields, I mean, I think your scenario suggests that real yields are too high. And historically, when real yields are this high, real yields are actually a pretty good predictor counter cycle to nominal yields. And so these real yields suggest that the Fed was, you know, tight enough to take this inflation out of the system. And you know, there'll be pockets of it for sure, but it certainly looks to us like those real yields can contract, and that's going to be a big part of what we see from the equity markets. I mean, 435 on the 10-year is the next support level, but you know, I think when we look back at October, I mean, you saw it in the capitulation signals around staples, the capitulation signals around utilities. I mean, how do these two defensive areas have capitulation signals when the market is, you know, correcting 7%? Well, they do because there was an alternative and people were going to bonds, and you saw it in the ETF flows. You saw the home builder ETFs were massive outflows because the sentiment became one-sided. 23% bulls on the 10-year yield. The sentiment became one-sided that we're going to do nothing but go higher on the rates, and that just caught people off guard. So I do think this market is in many ways predicated on a continued at least stability, if not decline, in the 10-year yield. Again, 435 is the next support level, but certainly I think the extent to which people were offsides in the bond market gives this some more thrust. And you know, we've got an overbought condition, but and you'll see it on our Twitter feed. You know, we find that there's an interesting asymmetry here. People believe that just because an oversold condition must be good, that implies that an overbought condition must be bad for equities or anything for that matter. And that's just not the way it works. Both overbought and oversold tend to be actually bullish signs for the equity markets. In other words, your return profile has this smile at the tails, right? You have extremes on either end, and they actually end up being bullish for forward returns. So I think the overbought condition that people are worried about is really more a reflection of momentum than it is something that's a liability. And clearly, we still have the seasonal strength that should take us at least through the end of the year, if not into basically the first 2/3 of January, I think, State of the Union. So, you know, most of these things that we expected or hoped would come to fruition have started to come to fruition. And I think that's going to be, you know, continued trajectory, and hopefully the data continues to support that. Speaking of State of the Union, let's go to Taiwan. Biden, they got together. I mean, some progress, but I think you're a little bit more skeptical that there's really anything to this, Steve. What are your latest thoughts on that?
I mean, I think it was more motion than progress. You know, they say diplomatically talking is better than not talking, but in actuality, you know, actions speak louder than words. And right now, we've just seen a desire, I think, to get what I would consider the lowest common denominator here with respect to resumption of military to military talks. That's important when you're talking about Taiwan, because you have increased military activity there, both the U.S. and Chinese sides, and that's just sort of increased risk that some inadvertent action could cause World War III. So there's a desire to reestablish those communications to avoid that. The reason I'm skeptical is because those military to military communications broke down after House Speaker Nancy Pelosi visited Taiwan in August 22. And Taiwan continues to remain a flashpoint. So when we fast forward to January, which isn't that far away, there's going to be a very important election there. And if that election doesn't go the way that Xi Jinping wants it to go, then I could see him using that as a catalyst to cut off communications again. So this could all be very short-lived. We saw with respect to other issues that may be of interest to investors, you know, there wasn't any desire to get China to change its geopolitical interest, which are always increasingly so at odds with the U.S. when you talk about the situation in Ukraine and Israel. And then you get into what didn't happen on artificial intelligence, you know, no agreement there on common standard settings moving forward. That shouldn't be surprising. There's been a lot of talk about, what's going to happen here on fentanyl. There was a lot of talk when Xi Jinping met with Donald Trump, and not a lot happened. Sort of a modern day opium war, retaliation from the Chinese side. So, I hope I'm wrong, but I guess I don't think I am. So, we'll see what happens there.
You're a show me kind of guy.
I am.
No doubt about it. You should be from Missouri. And how about the avoidance of the government shutdown? How big a deal was it? Just, I think you had the best line, punt, pass, or kick, right? This was just kicking it down the road.
Correct. What they did was the bare minimum, which is unfortunately at best we can expect now from our elected officials. And that's just keep the government open, avoid all the difficult decisions, and somehow hope that things are going to get better. But there's little reason for optimism that they will. So when Congress does return in December, there really aren't that many legislative days left. This whole supplemental security age package has not been resolved. You're still going to have to pass an annual defense bill, and then again to early next year. You mentioned State of the Union. We'll see if the government's open then, because it very well could shut down on that first date on January 19th, where you're trying to get sort of this low hanging fruit here in terms of bills that the House and Senate should have passed and been able to reconcile by then. That could be difficult because a lot of House conservatives, many of whom forced the ouster of Kevin McCarthy, are making it difficult for Mike Johnson. That honeymoon period has really come to an end rather quickly, because Johnson's strategy is to try to have the House pass partisan bills, but many of these House Freedom Caucus members, in sort of protest to this continuing resolution that Johnson put forward, are saying we're not going to pass the spending bills there in the House. So, from their perspective, maybe they're trying to get to continuing resolution next year, which under the Biden-McCarthy agreement would result in a 1% sequestration cut across the board. We'll see where that goes with the Senate. I think it's notable that the second funding deadline is on February 2nd, and that's Groundhog Day, which may not be a coincidence given what we're continue to see here.
Maybe they should just win more elections.
That's one thought.
Maybe they can think that keeping the government open doesn't hurt them politically, but being blamed for a shutdown does.
Again, it goes back to the district that you represent. If you're one of those R+20 districts, they might feel that there's some political benefit to them. But I think if you think to the Republican Party as a whole, I don't know that that's going to do anything to help them hold on to the House. It's going to be difficult.
It's a party that doesn't really want to win elections or govern. That's what it is. That's what it feels like, frankly.
So, Steve, if you had to letter grade Johnson at this point, probably not a fair assessment, but if you had to letter grade Johnson, where would you put him?
If I was going to take the easy out, I'd just give him an I for incomplete. But based on how he handled this situation, probably a B. You have to keep the government open. I think from Republicans, you want to keep more of the attention focused on Biden and his poll results, or lack thereof at this point, rather than have the media sort of turn everything on to you and being blamed for a shutdown. That said, he is sort of skating on thin ice, and he has a little bit longer leash now just because he's new to the role than McCarthy did. But as we sort of saw with McCarthy, once that group sort of starts to turn on you, your days are numbered. I think for him, that's unfortunately starting to happen relatively soon. Knives out.
What there's still this talk about Biden, withdrawing at some point in a kind of step aside, understanding the polls. Who is the most likely candidate? You're seeing it from notable people from the Washington Post and Axelrod and the like. These guys are generally plants, if you will, and part of the whole machinery. So who's the next man or woman up for the Democrats if that in fact comes to fruition?
Well, I think if you're sort of a Democrat, that there's a reason for skepticism for Biden, because in 2019 he was pointing to a lot of these early polls that showed that he was the electability argument, that he would beat Donald Trump in an election contest in 2020, which he did. And now those same polls are showing that he's losing to Trump. So this whole electability thing is actually working against him, which I think causing a lot of this consternation here. The problem is, I don't think Democrats want to step over the first Black female vice president, who polls show is actually less popular than Biden, and sort of have that difficult conversation amongst themselves, particularly if they want to go with a white male governor, somebody like Gavin Newsom from California, who has a very progressive record to run on, which may not be as appealing to some of these swing state voters. If I were the Democrats, I would go with Gretchen Whitmer, governor from Michigan, just electorally. I think she would bring a lot of those Midwestern states probably into focus. Looks relatively moderate. At that point, you'd be running against sort of the Biden administration. I don't know that running for anybody within the Biden administration, if his policies are unpopular, is the electoral solution there. If she wants to add Senator Raphael Warnock to the ticket, try to deliver Georgia there, it's probably enough states that you need to win. But I don't think Biden's going to step aside at this point. I think you mentioned David Axelrod. There was a lot of tension between the Obama people and Biden, during that White House. And I think a lot of these people, when they sort of tell him, not to do it, it probably makes him more inclined to do it. You can argue with that political wisdom. So if he doesn't make sort of a shift here, I would say by January, February next year, I think it's more than likely he does it, barring any health issue, which is not a 0% chance.
Right, no doubt about it. Neil, short week next week. What's on the ticket?
I have durable goods orders for October. That'll probably be the main event, and that's pretty much it.
And Steve, Washington is open.
Well, Congress is on recess, but the thing that I would watch for is Martin Gruenberg. He is the chair of the FDIC, been a long-time board member. And I bring that up because anybody seen the Wall Street Journal this week has seen several reports about a very toxic culture there. And given that he was a board member, he faced a lot of questions this week from lawmakers and from both sides. And he did not have good answers. In fact, he was actually forced to reverse himself after he said he wasn't subject to an investigation. And in fact, he was. So now there's sort of, is he going to be able to maintain his position there at the FDIC? And if he doesn't, that's pretty significant if you're a big bank, because he is arguably the deciding vote here for a lot of these banking regulations with respect to increased capital requirements and the like. Because if he goes and the FDIC is split, you will not get anything through there. And the Fed needs the FDIC for a lot of these capital requirements. So that could be significant. And there's not enough time to find a replacement. So that's sort of the thing I'm watching for is, will he still be in that role next week?
Now, I've been on Wall Street for 30 years and I've never heard of a, killer FDIC Christmas party. So I don't know what was going on over there, but
if you like strippers and excessive drinking, you just go to the hotel across from the FDIC, apparently.
Is that right?
If you have if you have allegations against them, you're going to get a nice $250,000 settlement. So maybe there's something to it. But
good Lord.
The government in terms of the 1980s Wall Street.
Yeah, I mean, really, it's like that's exactly what it was. Like
talk about long and variable legs.
So in terms of the S&P, we got through our resistance level, which is 4,500, and that's going to be violated. So 4,600 is the next level. And, look, I think there's a lot of good things that are happening. Bad charts are working. There were some momentum extremes. That tends to be in the near term, good news, not bad news. Focus on where the relative strength is. That's likely to turn out to be leadership for 2024. Again, I think discretionary will be an important part of this mix to see what the duration is. And we're going to continue to need our yield impact model to at least be well behaved, if not actually improve as we go. But you have seasonality, you have credit, you do have some indications of breadth and some thrust, not all the thrust that we look for, but certainly enough to stay tilted bullish between now and year's end. Watch discretionary, as I mentioned, and then watch for a continuation of a decline in energy because those do look more vulnerable to us. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter. And if you want deeper insight, join us at renmacaccess.com. Until then, I'm Jeff DeGraff.
I'm Neil Detta.
And I'm Steve Pavlik.
Have a great Thanksgiving.